It's your boy Lube here. China Tech ADR in the US tumbled on Friday in light of the news that Beijing officials were said to consider forcing companies that offer school tutoring to turn into non-profits. Over the weekend, many have asked me about my thoughts on the news development and how much they should be concerned about the political risks when investing into China. In this video, I am going to share my quick view on the news and 3 simple things to watch out for when investing in Chinese equities. On the news, I view the potential crackdown on these education companies as a battle against inequality instead of the tech firms or the Chinese capital market. If you follow the fundamentals of these online education companies closely like me, you wouldn't have been surprised by the news at all. Just to share some context, the K-12 education market is 700 billion yuan in 2020 and it is growing fast. However, despite the size and the growth, it is barely a profitable one. In fact, none of the top 5 online education companies have made any real money in profits. So under my frameworks, it is a market with a good story but bad fundamentals. Education has definitely been a sexy market in China given the severe lack of existing education resources against enormous demand, especially for the underprivileged groups, which means there are a lot of potential opportunities to create value. Everyone, even some officials, hope that these online education platforms would efficiently create and distribute education resources to all the Chinese families, creating positive social externalities. This explains why they have attracted so much capital over recent years. However, too much capital can be a double edge. Most of the capital flown into the top Chinese online education companies was spent on expensive marketing races against each other and exploitative sales techniques on the parents instead of developing and improving the quality of curriculums for the students. At the same time, in order to support these expensive races, the prices of these online curriculums are outrageous. Therefore, these online education companies actually worsened the inequalities in China. To me, it is only reasonable to crack down these capital-corrupted, resource-draining education companies in China, which is why I have been shorting GoTo since fall last year. And I think the blast radius of the news on Friday is confined to these education companies. It could actually be a buying opportunity for some of the other Chinese ADRs. In light of the news, I am maintaining my bullish view of investing in China, but I am not saying that you should ignore the potential political risks. Here are the 3 things I personally would watch out when buying Chinese stocks. 1. Invest in companies or areas with both good story and good fundamentals. 2. Size actually matters in China, as guys, you probably know that being too big could be a double edge, especially given the importance of control to the party. 3. Don't just invest in 1 or 2 companies, diversify. That's it for today, thanks for watching.